It's Monday, March 23rd, and welcome to another $1 Trillion Monday on Political Lunch. Welcome back to your Monday edition of Political Lunch. We start the week with a closer look at a story we mentioned last week in the Friday Roundup. The $1 trillion President Obama has directed the U.S. Treasury to spend to prop up the shaky financial markets. Today, the president revealed the details of his plan, and so far, the markets seem to like it. As of noon today, the Dow was up more than 4%. That would be the most significant one-day rise in stock prices since the market slide began last year. So what's so promising about this latest plan, and why are investors seemingly so excited to part with their money for the first time in months? Well, according to the New York Times, the Obama administration is attempting to, quote, draw private investors into partnership with a new federal entity that could eventually buy up to $1 trillion in troubled assets that are weighing down banks and clogging up the credit markets, end quote. Now that, as far as I'm concerned, is not a particularly helpful explanation. This is, after all, $1 trillion of your money being put towards something that is apparently appealing enough for investors to get bullish for the first time in a long time. So let me try and break it down for you. First, there are those so-called troubled assets that are, in the language of the Times, weighing down banks and clogging up the markets. In short, they're the mortgage-backed securities, mortgages bundled together, sold and resold in a process that generally obscured the underlying risk associated with those mortgages. And when the banks realized they'd bought something that was a lot riskier than they'd thought, well, the proverbial whatnot hit the fan. Of course, it's all a lot more complex than that, but for the purposes of this government plan, all you really need to know about the so-called toxic assets is that regardless of whether or not the bank should have bought them in the first place, as long as they're on the bank's balance sheets, it's going to be hard for the banks to raise new capital and thus issue more loans and unclog the credit markets. Now, since late last year, the administration has been talking about a plan to buy those assets from the banks in order to get them lending again. The problem is, no one really knows what those assets are worth, since there's no competitive market to bid on them and set the price. And that is where this newly announced Public-Private Partnership comes in. Today, the administration announced it will be using public money to create a government-backed marketplace for those so-called toxic assets. Now, by the way, it's worth noting that the banks and the government are no longer using the phrase toxic assets. Instead, they're going with legacy assets, which is the marketing equivalent of describing a used car as pre-owned. So a marketplace for those assets, that's the Obama administration's $1 trillion idea. And if you believe Treasury Secretary Timothy Geithner, the public has as much to gain from the scheme as do the private investors who will make up the second P in these PPIFs, or public-private investment funds. Now, the plan for managing those funds and matching private dollars with government money is complex to say the least, but here's an example from this very helpful Q&A up today on the NPR website. Let's say the Treasury finds a private investment partner to purchase a pool of mortgages for, say, $84 million. The Federal Deposit Insurance Corp, or FDIC, would guarantee $72 million of the financing. The Treasury puts up $6 million, and private investors do the same. So they put down a comparatively small cash down payment that's backed up by the much larger FDIC guarantee. All is well and good if that pool of mortgages winds up being a worthwhile investment and ends up being worth more than $84 million. But if that's not the case, the taxpayers are on the hook for the rest. That's when that FDIC guarantee kicks in. The private investors don't lose anything but that original $6 million they invested. If the mortgages do end up making money as an investment, the profits would be split between the private investor and the U.S. Treasury. In the meantime, the private investor is responsible for managing the asset, and of course only qualified investors, most likely other banks, Wall Street firms, hedge funds, etc., will be allowed to participate in the program. Now, critics of the plan, like New York Times columnist Paul Krugman, say the plan is overly generous to Wall Street and private investors, since the only thing they'll really risk is that small, original, unguaranteed down payment, and in return they get at least relatively valuable securities at fire sale prices. Now, another consideration is the AIG effect. In the light of public outrage over bonuses at AIG, a firm that received public bailout funding, will private investors be wary of partnering with the government if doing so will open them up to scrutiny for the big gains they obviously hope to achieve? Well, of course, there are no answers to that one yet, but we'll check back on this story when the PPIF program gets off the ground. That could happen as soon as early April. In the meantime, we'll be back next time with more politics and less high finance. Thanks for watching Political Lunch. See you Wednesday.